If you are new to investing in the stock market, stick around because in this video, I'm going to talk about 5 of the most common mistakes beginners make and why you should avoid them. Number 1. Ignorance of the investment. Warren Buffett, one of the world's most influential investors, advises against investing in businesses whose business models you don't understand. Building a diversified portfolio of exchange-traded funds, ETFs, or mutual funds is the safest way to prevent this. If you do plan to invest in individual stocks, make sure you know everything there is to know about the business they represent. To have a balanced portfolio, you must make well-informed decisions. A great way to be in the know is to watch education news, videos, books, and if you want to nerd out and read further into the company, check out sec.gov, type in the company's ticker symbol, and read their 10K. Number 2, a lack of perseverance. If you aren't a day trader and have been investing for at least a few years, you should avoid monitoring your portfolio's results on a regular or weekly basis. Short-term fluctuations will affect your decisions, so doing so is counterproductive because in the long run it goes up, typically over 10 years. Long-term returns would be higher if you expand your portfolio slowly and gradually. It's a formula for failure to expect a portfolio to do what it wasn't built to do. This means you can keep your plans for portfolio growth and returns reasonable in terms of time. Being enamored with a company is number 3. When we see a business we've invested in do well, it's all too tempting to fall in love with it and forget why we purchased the stock in the first place. Always keep in mind that you bought this stock to benefit. Consider selling the stock if any of the fundamentals that caused you to invest in the business change. Your confidence in the business you're investing in is important. Number 4, there is an excessive amount of pulling in and out of your investments. Unless you're an institutional investor with low commission rates, transaction costs will eat you alive, not to mention short-term tax rates and the opportunity cost of losing out on the long-term profits of other smart investments. So keep in mind short-term tax rates and long-term tax rates if you pull out because, say, you wanted to reallocate or you needed the money. Rule of thumb is to rebalance your portfolio once a year. Make sure a year is passed with your most recent investments before reallocating those. Negativity bias is number 5. Negativity bias is a psychological phenomenon in which negative experiences influence the decision rather than positive events. The large number of investors who stayed in the market after the 2008 market crash is a prime example of negativity bias. These investors were not aware of the massive turnaround that occurred in 2009 and beyond. With negativity bias, you may take a healthy path to prevent losses. It can, however, have a negative effect on you by causing you to miss out on opportunities to expand your investments. A critical review of your investment choices before you commit to anything can be aided by a cautious approach to negative news events. Number 6, engaging in herd mentality. This is a no-no. Herd mentality is a social phenomenon in which people imitate the actions of those around them. When it comes to investing, a common mistake is to talk about stock market returns when the market is doing exceptionally well. If you invest at that time, market volatility can cause your investment to lose money in the short term. Rule of thumb: buy low, sell high. Number 7, a lack of diversification. If you take one thing from this video, it's to diversify your portfolio. Professional investors may be able to produce a higher return than the benchmark by investing in a few concentrated positions, but beginner or average investors should avoid doing so. It is preferable to adhere to the diversification theory. It's important to have exposure to all major sectors in an exchange-traded fund, ETF, or mutual fund portfolio. Include all major sectors in your personal stock portfolio. As a general rule, don't put more than 5 to 10% of your portfolio in any single investment. This reduces risk in case one stock you invest goes down. You'll still have others that are doing well to balance that. Number 8, allowing the emotions to take over. Emotion is perhaps the number 1 killer of investment returns. The market is ruled by fear and greed, as the axiom goes. Investing decisions should not be influenced by fear or greed. They should instead concentrate on the big picture. Stock market returns may fluctuate wildly over a short time period, but large cap stocks have historically returned 10% on average over the long term. If you're a person who'll be emotionally affected if a stock goes down, you may be more of a bonds person. Stay tuned for a video on stocks versus bonds, which is better for you. Let's talk a little more on how to avoid making these errors and keep your portfolio on track. Make a plan for going forward. Determine where you are in the investment life cycle, what your priorities are, and how much money you'll need to achieve them. If you're not sure you're up to it, hire a reputable financial advisor. Also, keep in mind why you're spending your capital, and you'll be encouraged to save more and find it easier to decide the right portfolio allocation. Adjust your standards based on past market performance. Expect your portfolio to not make you wealthy overnight. Over time, a consistent long-term investment plan would create wealth. Patience. You will want to raise your investment as your income increases. Keep an eye on your investments. Examine your savings and their results at the end of each year. Put aside some fun funds. At times, we're all tempted by the temptation to spend money. It's just the way things are for humans, so rather than fighting it, embrace it. Make a separate account for fun investment capital. This sum should not reach 5% of your overall investment portfolio, and it should be money that you can afford to lose. Do not use any of your retirement funds. Always invest with a reputable financial institution. Since this is similar to gambling, follow the same rules you would if you were gambling. Limit your risk to the initial investment. You should plan to lose your entire investment. To decide when you will walk away, set a predetermined limit and stick to it. Making mistakes is an inevitable part of the investment process. Knowing what they are, why you're making them, and how to stop them can help your investment success. To avoid making the mistakes mentioned above, make a well-thought-out, structured strategy and stick to it. Set aside some fun money that you're completely prepared to lose if you ever do something risky. If you follow these instructions, you'll be well on your way to creating a portfolio that will provide you with several happy returns over time. When it comes to investing, errors are inevitable, but some can be avoided if you know them. Failure to develop a long-term strategy, allowing emotion and fear to affect your decisions, and failing to diversify a portfolio are the worst mistakes. That's it for this video. Thank you for listening, and stay tuned for more videos to advance your journey to becoming a knowledgeable investor. Make sure to subscribe so you won't miss out.